Welcome to the Kent Lapp Podcast.
So what I'd love to do is hear you talk through, if almost like you were coaching someone who had this idea that they wanted to found this startup company and use outside capital. And these types of things tend to be more focused on growth and revenue, I think, than cash flow out of the gate. And maybe there's an exit plan in 3, 5, 7, or 10 years, whatever. That whole model, I'd love for you to talk us through it.
Yeah.
If you're cool with that.
Sure.
And that's sort of, again, kind of compared or contrasted to a model where, I want to start selling these clay coffee mugs. And so, I get 10 grand together and I start selling a few and I try to cash flow and grow it from there, know?
Yeah.
So I guess maybe the first question is, how do you know when that's the right model? And how do you know when the model is actually, no, you just need to scrape some cash together and start and try to cash flow it?
Well, I think that's the first question you need to ask yourself. Do you want to have a lifestyle business where you might be selling mugs, but you grow at your own pace, you bootstrap, there's not intense pressure to grow quickly, to grow fast, because the most important thing about a startup is a startup because it grows fast, right? Mm-hmm. It is designed to grow quickly, like quick, like 30% a month, 10% a week, even down to that level. So I think you have to ask yourself, do I want a lifestyle business, but which can be a very large business? You can grow a business large. I know it's like super, sexy or attractive to have a venture-backed business, but I think you have to really ask yourself, do I want the venture pressure, and do I want to live that life and under that kind of stress to grow fast because I have somebody holding me accountable for this growth? Mm-hmm. And if that growth is not achieved, maybe you don't go on to the next funding round, or So there's a lot of drawbacks. I had a conversation last 2 weeks ago with a fellow who built a big business, $5 million in revenue or something, and he did it as a lifestyle business. He had been approached by some VCs, even some private equity guys, and just chose to grow it kind of organically. It took him longer. It took him, probably twice the amount of time it would have had he applied some capital to it. Mm-hmm. But yeah, so I think.
Was that a tech-based business or was that a product-based business?
It was ed tech business. So he was selling. It was also courses, which is why we connected.
Okay.
He was selling, I think, courses on like how to do animations or how to do video or how to do Adobe, Photoshop, mm-hmm. things like that.
Do you think that whether you're going to do a startup or a lifestyle business, is that what we should call the coffee mug business, where we just start making them, and mm-hmm. lifestyle business?
Lifestyle business.
Okay. Mm-hmm. All right. So do you think that the choice between a venture-backed startup and lifestyle business is primarily the type of business or what you're selling? Or do you think it's really what the founders want out of it?
I think it's both. So I think, one, you have to ask yourself that question, like what kind of life do you want to live? What kind of, mm-hmm. what's the, what's right for you? Then 2, like that coffee mug business is not, you cannot scale that indefinitely.
Yes.
So there's some businesses that can't scale to the degree that a venture-backed company needs it to scale, or a VC firm needs it to scale. Because VCs have a lot of pressures from their general partners, or LPs, what do they call them, to achieve a certain amount of growth or get a certain return on their investments, because a lot of them will go bust. Like a crazy amount will just go away.
Really?
So they have the few that are doing well have to do really, really, really well. Mm-hmm. So they're picking companies not based on the idea necessarily, but honestly, I've had a lot of conversations with VCs, and mm-hmm. A lot of them feel like they're chasing the next shiny thing, which is really frustrating. So it's more about, can they get that return? So I think, back to your question, I think you need to ask yourself, is my business really scalable if I were to apply capital? Like, can I? So, Bright Trip is a decent example. Like, we could sell an indefinite amount of courses. Our software allows us to sell as many courses as, we could sell courses to every person in the world. Mm-hmm. And our software could support that because, but you cannot build an organization large enough to provide everybody or sell a coffee cup to every single person in the world. That's a kind of a ridiculous example, but
well, it's a great example. I think it's a great example because it's so clear. So the type, because I always kind of picture like tech kind of making more sense with venture-backed startup, and like product-based businesses making more sense with lifestyle. But I guess I was looking for an example of a product-based business that did use venture-backed funding, and they probably exist, although I'm not thinking of one right now. Like I'm thinking of all the big ones, like Uber and Airbnb, but that's all basically a tech play. That's, they're not making the cars or anything like that.
Yeah.
Is there any product-based businesses where it might make
there
sense?
There are VCs that invest in hardware, customer. What do we call it? B2C type.
Sure.
It's not hardware. Hardware is a technology. There are some that exist, and I think it's there. I'm sure they have some kind of maybe they're investing in a brand. So I think about a luggage company, which is obviously luggage has been around for a long time, but it's a space that is kind of boring, right? It's a lot of Samsonite black suitcases. So this company called Away Travel basically became a travel brand, right? Not a luggage company. So they were a social driven business. So that's scalable, right?
Yes.
So you can scale that social component. Yes, you're still making a lot of suitcases. You can only make so many suitcases, but investing in a brand and growing a kind of a new white space like this social driven luggage category, whereas before, if you went to the what Dillard's or Macy's, whatever, it's just a wall of brands you've probably never heard of except for maybe one, right? And it's not even compelling. That brand is not compelling. It's not a travel brand. It doesn't make you want to travel or identify with that brand. So I think a lot of VCs kind of invest in those social-driven businesses when it involves a physical product.
Okay, that makes sense. So the scalability of the business is going to be a factor for choosing whether venture-backed or lifestyle makes more sense. What the founder is looking out of this idea, that's going to obviously impact that as well, of course. What else would be kind of factors in choosing whether venture-backed is the right model or not?
I think also like just thinking through how much capital is going to take to get this business to a place where you can raise serious capital. So it's really handy as a founder if you have a decent amount of cash to put into your business, especially if you plan to attract some venture funding. So I think the best example of this is Elon Musk. So Elon Musk sold PayPal for $230 million. His share of it was $230 or whatever. It was a lot. And then he went and founded Tesla and SpaceX. But he didn't need to attract capital. He didn't need to get this enormous amount of traction. So that's an outsized example, but it really is handy if the founder can invest a bit of money of their own. That way you can build a product. Because, investors invest in ideas sometimes, but usually venture is investing in growth. So they're investing in your traction up to that point and really just applying gas to the flame so you can grow. So not investing in a venture, they're investing in growth. There's very few, there are some seed stage or pre-seed actually. So there's some pre-seed VCs out there who are literally investing in an idea. But even then, like you need some kind of traction because you're trying to tick off the doubts. So can you build this product? Can you put together a team? Can you acquire a customer? What is your margin profile? Can you even get a margin profile that is interesting? There's just a lot. So it's really handy if you're thinking about trying to build a company that would attract venture funding, is either have some capital of your own that you can put towards the business, or kind of a network of friends and family, or kind of angel type investors that believe in you and would invest some in you.
Yes. So the founder puts some money in, or friends and family, or a combination of the above, to kind of generate that proof of concept to show like, hey, we've got something here. That really needs to happen before you go try to get, $2, $3, $5, $10, $100 million.
Yeah.
Right. But even the $100 million, you're not getting $100 million. You're first doing your own money, friends and family, and then maybe you get, I don't know, a couple mil or a mil. It would depend on the thing, right?
Yeah. Really the traditional path is either you or friends and family invest some capital. It's usually a couple $100,000. Once you kind of meet the milestones based on that and you achieve a certain amount of traction, then maybe you attract an angel who invests $500,000 to $1 million, depending on where you are, maybe $2 million if you're out on the West Coast. Once you meet those milestones and you have significant traction, then you often will move on to a seed stage. Seed stage is usually $1 to $3 million, $1 to $5 sometimes, depending on where you are. then again, you're using that capital. And again, the point is you're funding growth at that point.
Mm-hmm.
To even compete for this, you have to have a decent amount of traction and real revenue, or at least real users. Like a real user growth, or like a lot of revenue and a lot of users is the point.
Yeah. To
So
compete
just to
for
just to compete
for the venture round,
for the venture route,
which is 500,000 to $1 million, or if you're on the West Coast, 2 million. Say, yeah,
Exactly.
okay,
Yeah, I think there's a misnomer that like if it's a good idea, somebody will invest in it. It's really competitive. The venture backed or just capital in general is really competitive, and there's probably more money out there than there is good ideas, but still, it is really difficult. And there's that bar, at least from my experience, is really high to attract capital.
Mm-hmm.
Outside of the kind of friends and family or angel.
Yep. Yeah. Walk us through those numbers. So friends and family, let's call it. What would be the number on that? You think?
Yeah, I think it's first of all, it's on individual. So anywhere from $25,000 to $100,000, I think you could probably, and it's true friends and family. Like you're relying on these folks who believe in you.
Yep.
As a person more than you are a company.
And yeah, that's right. And let's think through a scenario where there's co-founder, because I feel like that's probably the most common, right?
Mm.
And all right, so you got two people with this idea, and they go out and get anywhere between 25,000 and 100,000 to get this thing. That's the kind of the friends and family round. But the friends and family that can be up to like 250,000, right?
Yeah, could be
kind of at that stage.
Sure.
It's kind of whatever you need. So now you get proof of concept. Then you're getting an angel. 500,000 to 2 million.
Yep, it could be. You could go straight to seed. It depends on how sophisticated the angel group or the angel is. Like there's some angels out on the West Coast that are writing serious checks, and they're have this fantastic reputation in the venture community of picking winners. So if you find the right angel, it's almost as good as a seed, because you might maybe gain enough traction to go to your Series A type round, which is a much larger check. So yeah, it's.
Yeah,
Depends.
It depends. Yeah, that is the active.
And I'm not the authority.
The active verb. And then when you get into seed, is that just before like round A, B, and C?
It is. Yeah.
Okay.
So seed is often your post revenue. You have real customers. You've acquired. You've found this repeatable process where you can acquire a customer profitably, and you're generating real revenue, or at least you are on a path towards generating serious revenue. And usually seed is that up to 5 million round, depending on the business and how much capital the business needs. 5 million, and usually it's almost an equation. Usually it's about 20% of the company that you give up for a seed round.
Okay. How much of the company would it be conceivable that you would have up until the seed round, though? Let's say in a situation where there's two co-founders, the friends and family round was $250,000, and then they got to the seed round. You're saying the seed round would take 20% or Series A?
No, the seed round.
The seed round, okay.
15 to 20%.
15 to 20% there. Okay, all right. So at this point, you've got 100% of the business except for the equity that you need to give up with friends and family.
Right.
What might be an equity amount that they might give up at the friends and family kind of round or category?
Yeah, so one of the things about early stage companies, it is really difficult to value that company. So there's been some interesting kind of methods, mostly like what they call convertible securities. So convertible securities delay that valuation question down the road, which helps the founders because you can kind of build your valuation. You can improve your valuation. And two, you can let real market makers or real investors value your company. Like professionals will come in and value your company. Whereas an angel, or especially a friends and family, you have no idea what is this category. Where's the valuation lie in this category? Or there's just not enough subject matter expertise at that level to understand it. So it's really really handy to do that. But yeah, often like a founder will give up 3 to 5%. I think depending on how much you raise. That is pretty typical. So I think kind of rule of thumb, if the founder after that first significant fundraise, usually $1 million to $2 million, maybe more, kind of in that seed type round, the founder kind of ends up with about 20 or giving away about 20%, give or take.
So now you've
much more than that is a disincentive for the founders.
Oh, really? Okay. So now you've raised, we'll call it $1 million or $2 million. and you and your co-founder at that point in the scenario that we're kind of laying out, you've raised $1 million or $2 million, and you and your co-founder still have 80% of the equity. Okay. And so 40% each. So then what happens at like Series A? And by the way, do most just never get to Series A except like the Ubers and the Airbnbs and all of them?
Yeah. I mean, there's a lot of Series A each year, a lot of capital raised, but I think it all goes back to what's your traction and what's your revenue. Like if you're going for a Series A, you probably ought to be on track for significant revenue. So maybe it's 5 million, or maybe it's at least trending towards that, a growth rate that trends towards that. And I think a rule of thumb is about 30% a month. If you're able to grow 30% a month on whatever your KPI is, usually it's revenue, then you should be able to attract some capital.
30% a month indefinitely, which obviously it's not indefinitely, but during an almost indefinite amount of time to get Series A.
Right.
That is so much growth.
Yeah. I mean, obviously it depends, but yeah, it's all, I mean, the point of a startup is fast growth.
Yeah.
And otherwise it's just a business.
Right. And is it designed to be fast because it's a fast world and things are going to change? And if you don't do it, someone else is going to. Is that why it's designed to be fast? Or because because these investors want their money back so quick?
Yeah. Well, I think not that they want it back so quick, they have to have it back at a certain point, and it has to grow large.
Yeah.
So they're looking for a 1x or 2x. I mean, that's great, especially for a normal investor. I'm sure tripling your money would be attractive. But a VC needs a unicorn. They need a big win. They need $100 million business valued at $1 billion. They need that $1 billion company, which 10x is typically how you value a tech business. Although that's changing some with some of these startups that have just grown big and gone bust. What's the WeWork? WeWork is starting to change some of that and some of the perspectives in the VC land. But so profitability matters, in other words.
Yeah. Yeah, they're a pretty decent example of that.
Because it used not to. WeWork, it did not matter. Growth at all. WeWork, it did not matter. Profitability was not
That's right.
Important clearly to that organization.
Yeah. By the way, whatever happened with them? Are they just completely done, or are they restructured?
No, I haven't kept pace with them, but
I haven't either.
We should go research it. It
really
really is a
our
case
internet's
study.
out right now, unfortunately, so we would look it up otherwise. But yeah, they just that was it. But what's interesting about that was, well, it was still pretty scalable though, because they were in on the lease side. But it got really weird with the founder wanting to buy everything too and lease it back to the company. It felt, I don't know.
Yeah, a mess.
Yeah, it felt like a mess.
Yeah.
It looked like a mess, I should say.
Yeah.
Okay. What if someone is going to do this and they have a great idea and they have a co-founder, and that's a situation, and they've built out some things and they've modeled it and it's going to work and they're just getting their toes in the water here, and they're ready to kind of go beyond friends and family? What are some things they should be thinking about when it gets into that next round, that kind of series round, like kind of getting into some legit investor money here at this point, right? Like, what are some things they need to be thinking about or being prepared for before they just kind of get what could maybe be like thrown to the wolves if they're not properly prepared?
Yeah, I think the best thing they can do, and the best founders think about not raising capital, but acquiring customers and meeting their business goals. So I would really focus on, because I think a lot of folks get caught up in fundraising, right? So you can spend a lot of time talking to a lot of investors, and it's really important that you raise this capital. But instead, I would encourage founders to really spend the energy on your business and growing your business, because if you grow your business, you'll attract capital. So really focusing on the customer. Back to our initial conversation, talking to your customers and understanding what's that white flame that is starting to kind of burn brightly in your business, and doubling down on that, or understanding customer trends, or why is your product resonating with customers? Have you found product market fit? Things like that. And how can I improve my margins, or how can I invest in this next product, or build this product out where it'll serve my customers better and then grow revenue. So I
Mhm.
think really focusing on that and not like putting together this, I guess, master plan for fundraising, I think is probably a best practice, because you will, if you're growing quickly, and it gets out that you're fundraising, it's not even, it's the problem solved.
Okay.
So I think really just focusing on growing your business.
So that's where you want to put. That's kind of that's where if you put in like 20% of your effort, it'll give you 80% of the results. Like that's where you need to put your focus, because that leveraged amount of where you're putting that focus is going to like help everything else, which I feel like is good news, right? Because I think most founders just want to work on the company, right? They don't want to, particularly on the revenue side, they don't want to be talking to investors.
Fundraising is literally a waste of time apart from the capital. I mean, I guess there is like smart money, if you can call it smart money, that maybe they can connect you with, especially if you have a SaaS company, they can connect you with customers, large customers, things like that. But yeah, I think, the role, especially if you're a CEO of a company, your job is to keep cash in the bank. So that is important. Mm-hmm. You can't let the company run out of cash. The business hasn't failed unless it's run out of cash. Mm-hmm. So I think as CEO, that should be top of mind. If that involves fundraising, then it should be a priority. But, coming up with a vision, recruiting the team, and keeping cash in the bank, or making sure you're executing on your business to keep cash in the bank is kind of the way you ought to think about it.
Yeah. Okay.
So it might require a fundraise. Yeah. If you need to go find cash, you ought to go find cash.
Yes. And then how are you projecting how much cash you need to raise? Are you just looking at kind of your cash burn rate and saying, here's what I need to accomplish X? Is that the primary thing you're looking at that point?
Yeah, there's two ways. There's like the really practical way, like, okay, what is my burn rate? And how do I, modeling that out. Then there's this more like theoretical building a financial model. I don't know if you've done this with some of your businesses, but like having that master spreadsheet with tons of formulas that model out your business. Mm-hmm. So if I do X, Y, and Z, or if I sell this, or if this revenue stream does this or grows at this rate, modeling that out. Mm-hmm. And there's certain capital requirements that'll need. Yeah. So your expenses will dictate, to grow fast, sometimes you need a lot of capital to grow fast. So I think early, just kind of understanding your burn rate, how much cash, how much runway you have for that. But later, and really before you really get in front of serious investors, really understanding that business model and what are those pivot points, what are those levers that you need to pull or invest in to meet your objectives in that business model. Mm-hmm.
And when you're getting,
sorry to interrupt. Yep, I feel like a lot of founders, early stage founders, do not understand their business model really well. They do not understand the economics of their model and how they're going to make money. They get caught up in the product or what could be, or the vision. But at the end of the day, the investor wants to know how you're going to make money.
Yes.
So I think describing that really clearly, it seems to be a challenge for a lot of founders, but it's really important. Like, what are those unit economics?
Yeah. Yep. And at that point, if you're talking to, investors at the $500,000 to $2 million range, they may ask for any financials that you may have into that point, or they're going to do some due diligence, but they're less concerned about whether you're buying water bottles for your office staff and more concerned about the revenue track and how quickly you can hit those revenue goals, correct?
Right.
That's really where they're focusing,
because they're digging into the business. Yeah. Not your culture necessarily, maybe, but the business.
Because what they want to do is they want you to sell or have an exit in X amount of years' time where they're going to sell to someone to get their money back plus a bunch, right?
Yeah.
And so everyone knows with this investor-backed kind of business model, everyone's clear all the way from the beginning, like what the end goal is, right? If it's an exit or whatever.
Absolutely.
And most of the time it is an exit, correct?
Yeah. I think all the time. Yeah, there needs to be some kind of exit, whether it's going public, which I think only 10% of startups go public.
Is it that many though?
That's the recent stat I read. That might be.
I guess that's still, it's just 10%. That number was maybe a touch higher than I would have thought, but
most of the companies end up in acquisition. And companies get bought, not sold. That's another key point. So usually, like you're bringing value to a larger company, so they buy you. They want to just own the product, or they want to own the roadmap, or they want to own the team who's executing on this.
So when you say companies get bought, not sold, you're speaking to sort of how the founders need to be thinking about who's going to buy this and why. It's not like, oh, one day I have a business to sell. I'm sure someone's going to want to buy it. You got to be thinking about who my buyer is going to be. Is that what you mean
Right.
behind companies get bought,
It's
not
almost a
sold?
mentality. Yeah. So, like, you're not going to go out there and sell your company one day. Somebody will probably offer you something because you're bringing value to that
Oh, I see.
company. So, like,
Okay.
so someone's going to buy you.
Yep.
You're going to have this inbound
Hmm.
kind of acquisition,
Mhm.
request or, just offer,
Mhm.
as opposed to you going out because your valuation goes way down if you're trying to sell something, right? But your
Yeah.
valuation goes way up if you have a buyer.
I see.
It's kind of like the bid ask system in the
Sure.
in the market, kind of the similar
Yep.
concept.
Yep. Okay. So going back to sort of these equity agreements, the SAFE, is that what it is called?
Mhm.
The SAFE agreement. That's kind of like that's what is it Y Combinator?
Y Combinator, yeah, they came up with that.
They came up with it?
They came up with
Okay,
it. Yeah.
I forgot that. But they use it a lot in any case, right? And that's what like Uber was built on. I was going to say Netflix, but maybe not. But that's a very common one in the tech space for venture-backed capital.
So there's two what they call convertible securities, and that again is um, the agreement is for future equity. So the SAFE stands for simple agreement because it's just it is literally a 5-page agreement, a simple agreement for future equity. So again, your shares, you don't have shares yet. You have a promise for future shares. So when that company when an institution values that company and invests, the trigger in that document converts at the same rate with a incentive, usually a discount of some sort.
Yep. Allowing everyone, both the founders and the people looking to put some money in early on, allowing the pressure to be taken off at that point about what this business is worth, how much equity they should get in return for their dollar, all of that, right? Because it's hard to predict that when you're at
Really
that
hard.
stage.
Yep.
And so,
honestly, it provides an opportunity for angel types or kind of everyday investors to invest in a company. Because before, just an enormous amount of paperwork. If you're trying to invest $100,000, the legal paperwork alone, this is decades ago or years ago, it just wasn't worth it. You couldn't paper it. But if you allow the institution to take care of that term sheet and all those terms that reside in that investment, then you can participate. So because you're not tied up in it's a 5-page agreement and you're leaving all the heavy lifting to the lawyers in the seed and Series A.
Yeah. Yep. Okay, so if you're talking to two founders and they're asking you for advice on, they've got what really looks like a great idea. They're confident in their ability to get enough of friends and family money to get this going, and they're about to be off to the races, so to speak. But you're giving them advice on kind of, both now, 6 months from now, 2 years from now, as they kind of work their way through this process. What are some of the things you definitely want to say to them?
I think it's never too early to start building relationships with investors, particularly if you have a top 20 list of firms that you want to work with for whatever reason. Maybe they're really well established in that category that you're in or that sector that you're in. It's never too early to start developing those relationships, even if you're pre-revenue. Just having those relationships is a great. You'll do yourself a favor because it just takes a lot of conversations with a lot of investors. And keep in mind, there's a lot of noise out there. There's a lot of competing voices with especially VCs. It's just a lot. So I think building a network, even an advisory network of other industry or customers, especially in a SaaS type business, having those customers that can be a part of your fundraise, if you will, is really positive. So the other thing I would say is channel partners can be really, really good for an early stage company. It's often hard to get a channel partner because you don't have enough. It's almost not worth their time. But if you can find a complementary channel partner or a larger company that makes sense for you to partner with, that can do worlds for your business.
Mhm.
It can result in early growth. It can result in an exit down the road. So I think really investing time to bring value to these early channel partners, not try to get something from them. I think that's a mistake. You're an early stage company. They know that you're early, and I think you bringing them value would go a longer way than trying to, see if they'll help you sell something.
Right.
So.
And by the way, can you define channel partner?
Sure. Channel partner is just it's an acquisition strategy, a customer acquisition strategy, which involves other companies. So, in other words, there's a company in your kind of vertical that helps channel customers to you. I think is how where the channel comes in. But they're sending you customers, so your acquisition costs go down. You're not paying to acquire those customers. The relationship is such that that larger entity, that larger company, that larger partner is sending you customers. Maybe it's a rev share, or maybe it's just a complementary relationship. Maybe you're bringing value to their customers. Maybe maybe it's mutually beneficial. But that would be a channel partner.
Yep. Okay. And let's assume one of those founders that you were giving advice to was a CEO. What are you telling him or her that, no matter what, like, here's the 3 to 5 things you've got to be focused on?
Yeah. I think being product obsessed is really important. Just really obsessing over the product. And because you have to have that product person on the team. I think that's really important. And just obsessing over your product. Make sure you get the product right. Understanding how people are using your product, how your customers are using your product. Why are early customers attracted to your product? Why is there a product market fit? Are you establishing a product market fit, or is that a false negative kind of thing, or a false positive? You say. So I think being product obsessed is really, really important. I think too, after the product, really before the product, or in line with the product, is finding the right team. So the CEO is responsible for, sharing the vision and like attracting a team. And I think attracting an A team, because A players attract A players, B players attract C players. So I think really finding that perfect team for this venture is really, really important. And that can be finding technical talent or finding the subject matter expert, the outsized person in that sector that is the perfect founder kind of market fit. Super important. And then too, I think, just making sure you have enough cash, I think is really, it cannot go, it's just hard. Making sure that you have enough cash in the bank to be viable, especially with the pitfall like COVID. I mean, there are a lot of companies who are well capitalized who ran out of cash quickly because, and not their fault, it's just an unforeseen bump in the road, and there'll be lots of those.
Yeah. Thanks for sharing your thoughts on all that. I really appreciate it. That is, it's helpful, and I am much more familiar with the sort of what we were calling the lifestyle business, where you get some money together. It's your own money. You start something, you cash flow and grow it from there. And that whole kind of venture back space is not something I'm very familiar with, but it's extremely common now, right?
Yeah, and I think the lifestyle business should not be undersold, honestly. Like, I think a lot of people have been attracted to this, the sexy kind of...
Right. I was going to say that,
Yeah.
It's new and flashy and kind of sexy, but it's not for it's not for
every
founder or founders, and it's not for every business model or product.
That's right. You're absolutely right.
Yeah. Great. Well, I appreciate that. Anything else you want to touch on with the venture back capital versus lifestyle?
No, I don't think so. I think that covers it.
Okay.
There's lots to think through, and it can be overwhelming.
Yeah.
But I think just focusing on building your company, revenue solves all problems.
Yes. Yes.
And
sales
lots of
covers a multitude of
sales.
sins.
Yes.
Yep. Well, thanks for coming back on, man. I really appreciate it. And I'm happy to hear Bright Trip is doing well, even with the pandemic. And because at this point, we're invested in it with you, man.
Yeah,
we've heard enough about Bright Trip on this podcast.
Your listeners are
no, the listeners are invested with you, man, for sure. So I hope that continues to do very well.
Thank you. It's been a lot of fun doing it. That's for sure.
I'm sure. And by the way, I was going to ask you, you full-time now?
Full-time.
Full-time Bright Trip. But that only happened in the last several months, right?
That is recent. Yeah, I left my full-time job, which was hard to do.
Yeah.
About 2 months ago.
Okay.
A month and a half ago.
Yeah, congratulations. Yeah. So I'm assuming at that point, just as a founder who left your full-time gig, you're kind of surveying the landscape. You're looking at how this business is performing. Like there's more knowns than there was 2 years ago and, 6 months ago. And you're just seeing the track that it's on. You have some level of certainty there that gives you kind of the permission or the kind of the freedom to quit your day job, so to speak.
Absolutely. That's exactly right.
Okay.
So especially if you're trying to attract venture, like you have to be full-time. The expectation is that the entire team is full-time.
Mm-hmm.
So that's where Bright Trip is now. We have enough traction. We have enough customers. We've sold enough courses. We have a model that is working for us, and we're ready to invest in that and press into that.
Yeah. All right, brother. Thanks for coming by.
Absolutely.
Appreciate you.
Yeah.
That was great.